Stop. Put down your phone. Tell your family you need 10 minutes. Lock the door if you have to, because what I'm about to reveal about the coordinated panic campaign happening on Wall Street trading floors right now is so urgent, so calculated, and so dangerous to your financial future that everything else in your life just became secondary. My name is William Lee, and for the last 48 hours, my inbox has been absolutely flooded. I'm getting reports from private wealth clients, from high net worth individuals in London and New York, from regular retail traders who hold significant positions in their brokerage accounts. And the story is the same in every single email. They are telling me that their brokers are proactively reaching out to them with an urgent message about silver. Now, if you've been in this game for any length of time, you know that brokers usually only call you for two reasons: to sell you a fee-heavy product you don't need, or to margin call you when you're broke. They do not call you to give you free winning advice. They do not call you to help you protect your profits out of the goodness of their hearts. But suddenly this week, the phones are ringing off the hook, and the script they're reading from is identical. It's coordinated, it's precise, it's a psychological operation designed to separate you from your silver before the biggest move of this entire bull market. They are calling clients who have held silver through the dark years, clients who bought at $20, who held through $30, who diamond-handed through every manipulation and margin hike, and who are now sitting on massive gains at $77, $80, and they are telling them with absolute certainty that the party is over. You need to get out now, today, before it's too late. But they aren't just telling people to take profits. That would be normal. That would make sense after such a massive run. No, they're going a step further. They're actively recommending that aggressive clients consider initiating short positions. They're pitching put options. They're pitching inverse ETFs. They're telling their own clients to bet against the strongest commodity bull market in a generation. Think about that for a second. Your broker, who supposedly has your best interests at heart, is telling you to short silver at $77 after it's gone from $20 to $80. They want you to bet against the asset that just made you wealthy. And the language they're using is designed to terrify you. They're not saying, we expect a pullback, or you might want to consider taking some profits. They're using words like meltdown. They're using phrases like structural liquidity event. They're telling grandmothers and retirees that a massive, unavoidable crash is guaranteed to hit the silver market in the next 72 hours, and that if they don't sell everything right now, they're going to wake up poor. They're painting a picture of a catastrophic flush that will wash away all the gains of 2025 in a single afternoon. They're saying the Bloomberg Commodity Index rebalancing, a dry, bureaucratic event that happens every year, is going to trigger a $6 billion tsunami of selling that will break the back of the bull market. They're telling you that professional money managers are dumping silver as fast as they can, and that if you don't join them, you'll be the last fool holding the bag when the music stops. Now, I want you to pause for a second. Step back from the fear. Take a deep breath, and think like a detective. Ask yourself the most important question in all of finance. Cui bono? Who benefits? Since when do the big bullion banks care about your financial well-being? Since when do JP Morgan and Morgan Stanley proactively call retail clients to help them time the exact top of a market so they can maximize their wealth? They didn't call you when silver was at $18 and tell you it was the buying opportunity of a lifetime. They were silent. In fact, they were publishing research reports saying silver would go to 15. They were telling CNBC that physical metals were dead relics of the past. They didn't call you when it broke $50. They didn't call you at $60 or $70. But now that silver is at 77, 80 and ripping higher, now that the COMEX is being drained and the Shanghai spread is blowing out to $7 per ounce, suddenly they're your best friends. Suddenly they're deeply concerned about your downside risk exposure. Does that make any sense to you, or does it sound like something else entirely? Does it sound like desperation? Because that's exactly what this is. This is not concern. This is panic. They are not calling to save you. They are calling to save themselves. They are frantically trying to manufacture sellers because they are desperate for supply. They need buyers for the short positions they're trying to cover. They need liquidity. They need your silver. You have to understand the basic mechanics of markets. For every seller, there must be a buyer. If they're telling everyone to sell, who is planning to buy? Who is on the other side of that trade? They are. The same banks that are telling you silver is about to crash are the ones who need to buy millions of ounces to cover short positions that are bleeding them billions of dollars every single day the price stays above $75. They are trapped in a burning building, and they're trying to convince you to run into the fire so they can use your body to smother the flames. They are likely short 4.4 billion ounces of a metal that is disappearing from vaults at a rate of 2 million ounces per day. Every single dollar the price goes up costs them billions in mark-to-market losses and margin requirements. They are bleeding out in real time, and the only way they can stop the bleeding is to trick you into folding your hand. They need you to sell your winning lottery ticket for pennies on the dollar so they can cover their shorts before the real explosion happens. And the weapon they have chosen for this psychological operation, the boogeyman they're using to scare you out of your position, is a technical, bureaucratic event that most people have never even heard of. They're pointing to a calendar event called the Bloomberg Commodity Index rebalancing. They're holding up this rebalancing event like a loaded gun, claiming it will trigger a $6 billion dump that the market simply cannot absorb. But here's what they're not telling you. Here's the part of the story that exposes this entire operation as the sophisticated bear trap that it really is. Let me explain exactly what the Bloomberg Commodity Index is, what this rebalancing actually means, and why the timeline of this crash makes their entire narrative fall apart. The Bloomberg Commodity Index, or BCI, is a massive passive investment vehicle that manages roughly $108 billion in assets. Think about the scale of that number. This is not some hedge fund manager making tactical bets. This is a robot. It's an algorithm. It's blind capital that simply tracks a basket of commodities according to strict rules written by mathematicians in New York. It holds everything from crude oil to soybeans to coffee to gold to silver. And because it's a passive robot, it follows a rigid calendar. It doesn't make emotional decisions. It only moves when its programming tells it to move. And the most important line of code in its entire software is the January rebalancing. Every year in the first weeks of January, this $108 billion robot has to perform maintenance. It has to look at its portfolio and adjust the weightings of every single commodity to match new target percentages decided for the year. For 2026, the governing committee has decreed that silver's target weight must be cut from approximately 4.49% down to 3.94%. On the surface, this looks like a straightforward sell order. The brokers are screaming, "Look, the biggest whale in the commodity market is dumping silver. This is a vote of no confidence. You have to sell before the robot does." But that's the deception. The robot isn't selling because silver is bad. The robot is selling because silver was too good. The index has rules. It has caps. It's not allowed to let any single commodity become too dominant. And because silver performed so spectacularly in 2025, it more than doubled from $30 to over $80. It grew too big for the basket. It started taking up too much space. The rules say it must be trimmed. It must be pruned back to size. It's the penalty of success. But the brokers aren't telling you that. They're telling you this is a meltdown. They're telling you this mechanical adjustment is going to trigger a cascade of selling that breaks the back of the bull market. And to make the fear stick, they're throwing around massive dollar figures. They're saying that even a small percentage adjustment in a $108 billion fund translates into billions of dollars of selling. And here's where the math gets interesting, because the people on social media trying to calm everyone down are saying, relax, the target is only dropping 0.55%. That's tiny. It's only 600 million. Why is everyone panicking? But those people are wrong too. They're doing first-grade subtraction and missing the most critical variable. They're forgetting what silver actually did in 2025. When the year started, silver was taking up its assigned 4.49% of the basket, but then silver doubled in price while most other commodities stayed flat or went down. By December 2025, silver wasn't taking up 4.49% anymore. It had swollen to nearly 9% of the fund's total value. So when the rebalancing robot wakes up in January, it doesn't just sell the difference between 4.49% and 3.94%. It has to sell the difference between 9% and 3.94%. It has to dump roughly 5% of the entire $108 billion fund. That's approximately $5.4 to $6 billion. If you convert that into ounces at current prices, you're talking about 70 to 78 million ounces of silver. That's almost 10% of entire annual global mining production being sold in a matter of days. This is why the brokers sound so confident. They have the spreadsheet, they see this $6 billion wave, and they're telling you it's mathematical suicide to stand in front of it. But here's where they're lying to you. Here's where the trap is set. They're pretending this $6 billion sell order is hitting the market right now. They're pretending it's a surprise. They're acting like this massive fund waited until this week to execute the biggest trade of the year. But that's not how professional money works. That's not how any of this works. Let me ask you a simple question. If you knew with 100% mathematical certainty that a massive whale was going to sell a huge amount of silver in January, would you wait until January to react? If you were a professional trader at Goldman Sachs and you saw the BCI announcement back in October 2025, would you sit on your hands for 3 months waiting for the price to potentially drop? Absolutely not. The moment that announcement was made in October, the smart money started moving. They started front-running the trade. This is the dirty little secret of the index game. The BCI rebalancing is not a surprise party. It's the most telegraphed punch in financial history. Everyone knows it's coming, everyone knows the size, everyone knows the date. So the active managers, the funds that track the index but have freedom to trade around it, they didn't wait for January 8th. They spent November selling into strength. They spent December selling into the rally. They slowly, methodically offloaded that $6 billion of exposure while the price was ripping higher. They used the liquidity of the bull market to hide their exit. They fed the market while demand was strong. By the time we get to January 8th, 2026, by the time brokers are calling you screaming about meltdowns, the vast majority of that selling pressure has already happened. It's already been absorbed. The reason silver didn't go to $100 in December, the reason it paused and consolidated around 70 cents, $80, was precisely because this selling was taking place in the background. The market has already eaten the $6 billion meal. It's digesting it right now. What's left for this week? Only the dumb money. Only the strict passive ETFs that are legally prohibited from trading early. They must trade on their rebalance date, but these funds represent maybe $2 to $3 billion of the total. They're the tail of the dog, not the dog itself. And this reveals the true nature of the broker calls. If JP Morgan knows that the smart money already sold in November and December, and they know that only passive robots are selling today, why are they telling you to short now? Why are they telling you the crash is coming this week? Because they want you to sell the bottom. They want you to look at the selling from passive robots, which might push price down $2 to $3 for a few hours, and mistake it for the beginning of the end. They want you to panic dump your positions into a market that has already priced in the event. They're trying to get you to provide liquidity to the very same active managers who are now looking to buy back in at lower prices. Think about the cycle. Active managers sold in December at 82.85. Now passive robots sell at 75.77. The active managers are sitting with cash, waiting to buy those shares back from the robots and from you to ride the next leg up. The brokers are helping them close the loop. They're recruiting you to be the victim in a game of musical chairs that ended weeks ago. This is why I call it a hoax. The volume is real. Yes, $6 billion was sold, but the timing is the lie. The impact is in the past, not the future. This is a rearview mirror event, and while the West obsesses over this paper shuffle, while New York traders sweat over basis points and rebalancing dates, there's a force in the East that couldn't care less about the Bloomberg Commodity Index. There's a buyer who doesn't use algorithms, there's a buyer who uses ships, and this buyer is looking at this manufactured dip not as a panic event, but as a clearance sale. We need to talk about the China shield. We need to talk about why every single ounce these robots dump is being instantly swallowed by a dragon. Right now, as I'm recording this on January 9th, 2026, the Shanghai Gold Exchange, the physical hub where metal actually changes hands in China, is trading at a massive premium over COMEX in New York. We're seeing a spread of $6.07 per ounce. Do you understand the physics of what that means? It means a bar of silver is worth $7 more the moment it crosses the Pacific Ocean. It's an arbitrageur's dream. It's free money. If you can buy silver in New York for $75 and sell it in Shanghai for $82, you don't just do it once. You do it until the vault is empty. Now think about what the BCI rebalancing actually does in this environment. The robot dumps paper onto the New York market. This temporary selling pushes the COMEX price down from $80 to $75. The brokers cheer. The shorts celebrate. They think they've won. But what have they actually done? They haven't destroyed demand. They've just put the metal on sale. By pushing the New York price down while Shanghai stays high, they've widened the arbitrage spread from $7 to $12 or 15s. They've turned a profitable trade into the trade of the decade. They've subsidized Chinese accumulation of silver. Every single time price dips in New York, the vacuum cleaner in the East turns on full blast. Arbitrage traders, global banks, commodity houses, Chinese state-owned enterprises, they look at that $75 price and they scream, "Buy!" They scoop up every ounce the robots sell. They take delivery. They load it onto ships. They send it to China. The dump that brokers are warning you about is actually a gift to Beijing. It accelerates the drain. It speeds up the very shortage that drives prices higher in the long run. The BCI is literally transferring wealth from Western pension funds who are forced to sell low to the Chinese government who's happy to buy low. And why is China buying so aggressively? Why is there a physical floor under the market that refuses to break? Because China isn't trading for quarterly bonuses. They're trading for survival. They control 80% of global solar panel manufacturing. They know that without silver, they cannot build solar panels. Without solar panels, they cannot achieve energy independence. They're looking at the same geological maps we are. They see mine supply shrinking. They see industrial demand exploding. They see the West playing paper games while physical metal disappears. So when they see a rebalancing event, when they see foolish Westerners selling silver because a rulebook told them to, they don't panic. They laugh, and then they buy. For weeks now, the highest volume trading sessions have been Asian sessions, not New York, not London, Tokyo, Shanghai, Singapore. While you're sleeping, China and Japan are inserting billions of dollars into silver every single night. They're accumulating at a pace that has never been seen before in commodity markets. This is the China Shield. It's a massive, impenetrable wall of buy orders sitting just below current price. It ensures that any dip caused by rebalancing will be shallow and short-lived. You cannot crash a market when the biggest buyer in the world is standing there with an open checkbook praying for a discount. So if you listen to your broker, if you short the market right now, you're not betting against a bubble. You're stepping in front of a freight train called the People's Republic of China. You're betting that a paper algorithm in New York is more powerful than the industrial demand of the world's second largest economy. That's a suicide bet. The banks know this. JP Morgan knows the spread exists. They're probably the ones trading it, but they need you to be the liquidity on the other side. They need you to sell your physical or your ETF shares so they can cover their shorts before the inevitable snapback occurs. They're using the rebalancing narrative as a smokescreen to hide the fact that they're terrified of the East. They know that once this selling window closes, which is a matter of days, there's no more inventory coming. The passive funds will be empty, but Chinese demand will still be there, and that's when the real fireworks begin. That's when price stops reacting to New York and starts reacting to Shanghai. Let me tell you what's really happening here at the deepest level. The Western financial system is built on paper, on promises, on fractional reserves. They've sold 100 ounces of paper silver for every 1 ounce of physical in the vault. This worked for decades because nobody demanded delivery. Everyone was happy to trade paper certificates and settle in cash. But that system is breaking down right now. China is demanding physical, industrial users are demanding physical, even retail investors are waking up and demanding physical. The COMEX registered inventory has dropped from over 100 million ounces to about 120 million ounces. At the current delivery request rate, they hit zero by end of January. The banks are staring at a default. They sold promises they cannot keep. They sold metal they don't have. And with price at 70 cents of it to $80 and inventory disappearing, they need a miracle. The BCI rebalancing is the only miracle they have left. It's the only scheduled event that guarantees selling pressure. It's their one chance to create enough noise, fear, and confusion to cover their tracks while they try to exit positions. They're hoping that if they scream meltdown loud enough, you'll panic. They're hoping you'll look at a red candle triggered by a mindless robot and mistake it for the end of the world. They need you to be the liquidity. They need your shares. They need your contracts. They need your physical bars, because if you don't sell to them, they have to buy from China at $90 or $100 or whatever price China demands. They're begging you for a bailout. They're asking you to sacrifice your position to save theirs. And they're using sophisticated psychological warfare to make you think it's for your own good. So here's my final instruction to you for this week. When that phone rings and you see your brokerage firm on caller ID when they start reading from the script about downside protection and rebalancing risks, hang up. Do not engage. Do not debate. And certainly do not sell. Do not let them talk you out of the only asset that's effectively immune to the debt collapse of the Western world. Do not trade your sovereign wealth for their dying paper promises. You need to have the discipline to look past the next 48 hours. The rebalancing window is closing. The robot is almost done selling. The dumb money is almost done panicking. And once that selling pressure lifts, which is days, not weeks, the weight is gone. The beach ball is released. Price won't just recover. It will snap back with violence that shocks the shorts. We're looking at a slingshot maneuver that takes us straight through $84, opens the road to $100, and potentially to $120, $150 by February or March. The fundamental drivers haven't changed. Mines are still empty. Solar panels are still being built. The dollar is still dying. COMEX inventory is still draining. China is still buying billions every night. The only thing that changed was a line of code in a Bloomberg Index. And that line of code is irrelevant to the laws of supply and demand. This is a game of chicken. The banks are revving their engines, flashing their lights, driving straight at you, hoping you'll flinch. But their car is made of paper, and your tank is made of silver. If you hold the line, they crash. If you hold the line, the 4.4 billion ounce short position blows up. This isn't just a trade anymore. It's a transfer of wealth. It's the wealth of the manipulators flowing into the hands of the stubborn. Be stubborn. Be the immovable object. Do not be the victim of the meltdown hoax. Be the beneficiary of the rebalancing sale. If they push price down to $72, thank them and buy more. Because in 6 months, when we're trading at $150, you won't remember the BCI. You'll only remember that you didn't let them steal your future. The brokers are calling because they're desperate. The media is screaming because they're paid to. The algorithms are selling because they're programmed to. But China is buying because they understand reality. And reality always wins. This is William Lee. The hoax is exposed. The trap is identified. The decision is yours. Hold the line or become the exit liquidity. Choose wisely. Your financial future depends on it. Let me give you one more piece of evidence that this entire broker campaign is coordinated manipulation. Look at the timing. Why are these calls happening now, on January 8th and 9th, 2026? Why not last week? Why not in December when the smart money was actually selling? Because they need maximum psychological impact at the exact moment when the passive funds execute their trades. They need you to see a red candle on your screen while your broker is on the phone telling you, "See, I told you it was coming. You need to sell now before it gets worse." They're synchronizing the fear with the mechanical selling to create the illusion of a stampede, but it's theater. It's a stage play designed to trigger your panic response. And the only reason they're working this hard, the only reason they're spending millions on phone campaigns and media appearances, is because they know the window is closing. They know that once this week passes, once the rebalancing is complete, there's no more scheduled selling on the calendar. They lose their last weapon. This is their final desperate attempt to shake you out before the rocket launches. Don't fall for it. And here's what you need to understand about the next 30, 60 days. We're not just looking at a recovery back to $80. We're looking at a potential breakout that rewrites the entire commodity landscape. Because once the BCI selling is absorbed, and it will be absorbed by China, by arbitrage traders, by industrial users who need physical metal, the market will realize something profound. It will realize that there was $6 billion of scheduled selling, the biggest known selling event of the year, and the price didn't crash. It held $75. It bounced back to $77 to $80 within hours. What does that tell you about underlying demand? It tells you the bid is so strong, the physical shortage is so severe, that even a $6 billion dump can't break the market. And when that realization spreads, when traders understand that the floor is unbreakable, the fear of buying at high prices evaporates. Suddenly, $77 doesn't look expensive anymore. It looks like the last cheap entry before $100. The FOMO that's been held back by this rebalancing fear will explode. Every fund manager who was waiting on the sidelines for the big drop will realize the drop isn't coming. They'll rush in simultaneously. And that's when we get the vertical move that takes us from $80 to $120 in a matter of weeks, not months. The brokers calling you today will be silent then. They won't call to congratulate you. They'll be too busy explaining to their bosses how they got caught on the wrong side of the biggest commodity trade of the decade. The brokers are calling because they're desperate. The media is screaming because they're paid to. The algorithms are selling because they're programmed to. But China is buying because they understand reality, and reality always wins. This is William Lee. The hoax is exposed. The trap is identified. The decision is yours. Hold the line or become the exit liquidity. Choose wisely. Your financial future depends on it.